If you allocate assets for a living, the past year has been stacked with dilemmas. The most productive choice in hindsight was probably to keep it all in growth stocks. But in a world with much higher interest rates, income investments, be they debt, credit, or companies yielding dividends, have delivered too. And being diversified when the future is in doubt is at the very least a good way to get a better night's sleep. So, Caroline, now that many of us returned from the summer break, should we be looking at a wider spread of assets?
Absolutely. We've seen over the last 2.5 years that the correlation between bond and equities has shifted more positive. So this is the environment where you need more breadth in portfolios and more nuance within asset classes.
I'm Seb Morning-Clark, and this is Fidelity Answers, the series where we take the questions that investors are asking and put it to the people managing their money. With me to help us plot a way through a new season for markets is someone who does that for real, and that's multi-asset fund manager Caroline Shaw. Caroline, what's the question that you've brought to the studio today?
So we are at an interesting juncture in markets, and bonds and equity markets are sort of directing us towards maybe different outcomes. And so I'm looking at how can I build more resilience in my portfolios?
Well, and when it comes to resilience, who better to ask than the income experts? And here to help us shake off the holiday lull and stabilise our cash flows are two specialists representing both dividend and debt investing, fixed income fund manager James Durance and equity fund manager Tristan Purcell. Welcome to you both.
Hello.
James, let's start with what's keeping you up at night, shall we? Are there any red flags that you're watching particularly closely at the moment?
I think one thing that is keeping a lot of fixed income investors up at night at the moment is tremendous uncertainty about the path of long-term interest rates, especially in the US, but actually in many markets around the world.
And Tristan?
My gut reaction to what's keeping me up at night is the kids, but relevant to investing, I'd say the impact of AI on lots of different value chains and different businesses and how it might disrupt profit pools.
Very good. Okay, well, James, let's cast our minds back to the beginning of the year. It feels in many ways that we've sort of done a 360 since then. Are the issues that investors faced back at the beginning of the year the same as that they're facing at the moment?
I think broadly they are. I suppose if we rewind back a little bit further, we were in an ultra low interest rate environment for many years after the financial crisis, and that really changed in 2022. So since then, we've actually been in a high interest rate environment, which has actually made markets, I think, more interesting because it means that fixed income yields are quite high and they compare actually quite favourable with equity yields as well. And so I think from an asset allocation point of view, that means that fixed income, perhaps is kind of more interesting and more influential in a diversified portfolio.
Well, diversification is definitely one of the buzzwords of 2025. And another theme that has been dominating has been around market concentration, Tristan. Do you think it remains too concentrated, too narrow?
I guess too concentrated is a difficult one to judge, but we can definitely say that it's got more concentrated over the last decade. You can see that compared to any historic period now, we're in an extremely concentrated environment. So you've got the US being 2/3 of the world market. You have big tech plus the Mag 7 being, I think, nearly half of the US market. And the top 10 companies in the US are, I think, around 40% of the US market. So, whenever you have periods of extreme concentration like that, it introduces risk, particularly if you're taking a passive or a benchmark aware approach. And I guess the obvious question is what happens when it unwinds. And when it does unwind, you can look at periods like the dot-com era, where you had 5 years from 2000 to 2005 of the S&P, I think it fell around 10% in aggregate, whereas the S&P equal weight actually expanded, I think, around 30%. So it is still possible to perform or to produce decent returns in periods of unwinding concentration, provided you're not too benchmark sensitive.
And I guess this is one of those areas, Caroline, that you're looking to build this resilience around.
Yes, absolutely. That breadth is really important. I'm just thinking about and coming to you, James, on the income strategies and what's really been working well and what hasn't been working this year. I guess thinking about, it's been an incredibly tricky year to navigate so far. So if you could rerun the past few months, is there anything that you would do differently?
Yes, I think we always have a tendency as portfolio managers to sort of look back and focus on our mistakes. So I'm certainly guilty of that as well. I think in particular April this year with the Liberation Day sort of mini crisis as it turned out, many people became sort of very defensively minded, and in particular pretty negative about the US economy and about US risk assets in general. I would say I was also one of those people. And I already had quite a low exposure to the US market. Part of the sort of joy of global diversification, I guess, is you can look for cheap markets, not just the largest markets. So I already had a low allocation to the US, but with the sort of particularly aggressive policy of the US administration, I actually thought there was cause to sort of reduce that still further. So I did sell, a little bit more US exposure, and as it turned out, that probably wasn't great timing. Ultimately, the sales that we made in the income portfolios were small by nature, so they didn't impact portfolio returns too much. But in hindsight being a wonderful thing, we actually should have just gone much more aggressively pro-US in early April, because the US market at that point was pretty cheap.
And I'm sure it's something that many others did exactly the same as well. And I suppose, Tristan, how have equity income strategies performed this year, or helped through that sort of period? Have they sort of done what they were meant to have done?
It's very much a game of two halves, to borrow a football phrase. At the start of the year, you had a period where the US was particularly weak, dollar was weakening, volatility was rising as investors generally got to grips with what Trump's policies were going to entail. And then post-Liberation Day, you've had a period where the dollar's been much flatter, the S&P's broadly kept up with the rest of the world, and volatility's fallen. So in the first period, the natural equity income investor performed quite well, or should have done quite well. And then the second half of the year, we've struggled to keep pace. But what we're trying to do in the net of all of that period is we ended up ahead.
And we've seen, Tristan, we've seen quite heavy flows into Europe during the earlier part of this year. I think maybe investors front run Liberation Day a little, and we saw great returns for Europe versus US assets. That maybe has shifted a little as the US caught up post Liberation Day. How do you see that going forwards? Do we think there's still more fuel in the tank for European equities, given they had a good run and maybe have stabilised, and I guess the tariff uncertainty for Europe and collectively acting as one bloc against the US? Maybe there's some downward pressure on European equities there. How are you feeling about them?
I think the first half of this year before Liberation Day, I think maybe brought home to people how concentrated the US market is and the risks present in just investing there, which is what you're doing if you're taking a benchmark approach. And we certainly saw in client interactions throughout this year that people are now much more open to the idea of having exposure to the rest of the world. And we see it in questions now, like we used to get a lot of questions on why we only have 30% or 40% of the fund in the US, which is a massive underweight. And those questions aren't so pushing anymore. But I think what really has to happen for this shift to keep going, for momentum to keep going, is that the fundamentals of US companies have to start slowing relative to Europe. You can see over the last decade or so that most of the US's growth has come from the Mag 7. If you strip those out of the S&P and look at the S&P 493, the earnings growth for those companies isn't differentiated really from the rest of the world. So again, it comes back to concentration. And if those slow, then I think the interest to continue that flow into Europe will be stronger.
James, do you agree? Do you think people's minds have really changed about destinations of capital and overall balance?
I think there was certainly quite a big de-risking from US as a country of risk from non-US investors, starting in sort of Q1 this year and going on to that. And I suppose that a lot of people have been, challenged in that thesis, right? Because as Tristan said, the US market has effectively sort of bounced back and performed in line or even a touch better since then. So that kind of allocation call has ultimately not been the correct one in some parts of the world. But I don't think that the sort of last 6 months have really changed that view that basically people need to de-risk from the US. Why is that? Firstly, it's because the administration is just a bit more volatile and a bit uncertain, and so uncertainty creates enemies. And secondly, because I think people have realised that they have effectively over-allocated to the US over the last 20 years. So the US represents way more than the sort of GDP effect of the country in equity markets, in fixed income markets in particular. And people are just looking for, a greater global diversification. So I actually think that trend will continue and probably should continue. And even you could suggest that the US administration would like it to continue. For deficit reasons as well.
I've got a very clear picture in my mind of the reallocation of capital from the equity market side, but how is that playing out in the bond markets, and where are you seeing the value now?
So in the bond market, so I suppose you're talking about sort of two markets really, the government bond market and then the credit market. The credit market, to be honest with you, is a bit simpler. So it's basically a spread product over a risk-free, in inverted commas, rate. And credit is just a number, so it's a number that dictates credit risk, and so in a sense that's a little bit easier for us to define because we can look at relative value in credit around the world, adjust that for credit quality, and effectively sort of look at where the markets are cheap and where they're expensive. And guess what? But at this time, the US market looks expensive again. Having looked cheap for about 1 month, it went back to looking expensive and still looks expensive now. The government bond market is pretty different, and unusually at the moment we're now pricing like a very large amount of rate cuts in the US, and very few rate cuts in other parts of the world, especially in Europe. That's unusual because for so long the US was the economy that was growing and Europe was the economy that wasn't, that you kind of had the opposite priced into rates curves. And I think what complicates matters further at the moment is that it's a bit unclear, as I mentioned at the beginning of the piece, why are so many rate cuts priced into the US? Is it A, because the economy is slowing, maybe, or is it B, because the sort of US administration's influence on the Fed is growing and creating a more dovish Fed, which arguably is not a great thing. So that's why I think there's so much uncertainty in the US bond market at the moment.
Now, one area I know that you've been looking at closely, James, is real estate, which is obviously an asset class that can provide a nice steady income. It's been a good place to be in the last year or so. It's also one where positioning and valuations may have now come full circle. To find out more, earlier in the week I spoke to property credit analyst Othman El Iraqi. Othman, thanks for dropping by to talk to us today. We want to talk about real estate. It's done particularly well over the last year or so. Perhaps you can just give us a bit of a brief overview as to what the main drivers of that performance have been.
There have been a lot of factors that actually can explain the good performance of real estate last year. I think probably the main one is interest rates. So interest rates coming down, and we have to put that into context because in 22, 23, especially in 22 when interest rate went through the roof. Actually, this has caused a lot of issues, I would say, for real estate and for real estate companies. The first, of course, is higher funding cost for highly levered companies. But also the other thing is market values went down dramatically because rental yield had to adjust to the new interest rates environment. So values went down. Sentiment towards the sector was really bad, and everything kind of improved quite dramatically back in 2024, and that explains the strong performance, but also the fact that those companies in the last in 22 to 23 they sold a lot of assets. So they tried to fix their balance sheet. So they could not really raise equity, but they sold a lot of assets and they started reduce debt, and that helped a lot as well, the sentiment.
So they got their house in order, if you excuse
Exactly.
the pun. So things have been looking a bit more rosy then for the asset class in the last year or so. What are the risks, however, that are on the horizon as we move into this final quarter of 2025?
Yeah, I think there are still a lot of risks ahead. I think the sector is not completely out of the woods. I mean, we haven't seen really the transaction market picking up dramatically. it's still relatively subdued. And the main reason for that is the fact that government bond yield, especially the longer end, is actually still pretty high, and this weigh on valuation of real estate. And this definitely doesn't help the transaction market, because you need to justify the rental yield when you have your government bond yield at this sort of level.
So we should stop buying.
No, I don't think so. I think, to me, the worst is behind us. So values have corrected quite dramatically in the UK and in Europe, but it's just that for the moment the market has not completely come back. So I don't see values continuing to come down significantly from here. But it's going to be slow. It's going to be slow.
Okay, so some concerns over rising government bond yields. What about interest rates, though? To what extent are they going to either help or hinder the sector going forward? Because as you mentioned, this was definitely a beneficiary to the market not so long ago, and we are expecting the interest rate cycle to continue to go down as we head further into the year and into next year.
Yeah, I think it's definitely a positive, for the sector. I mean, those companies have already started to reduce debt. So actually, they're in a position where most of them their balance sheet is actually fit for purpose. In this new interest rate environment. So if interest rates stay where they are or go down, it's definitely going to be a positive for the sector.
There's some calibration that needs to take place.
Yeah.
Othman, thanks very much for talking to us. That was Othman El Iraqi. James, do concerns over fiscal expansion, rising government bond yields, do they make you wary of property as an asset class right now?
No, in a nutshell, although there is clearly a link and a correlation between how real estate performs and how bond duration performs. So it is a duration-sensitive asset class. The reason it doesn't concern me as much at the moment is the sector went through a sort of massive despair and then repair phase. And we actually really like those sectors from a credit perspective, because it creates very powerful incentives for management teams to improve their credit. So to deleverage, to sell assets, to get their credit ratings back to sort of healthy levels and so on. So we actually like those kind of repairing fundamental stories. Even if some of the backdrop is quite tough, that tends to lead to a tough backdrop, but cheap valuation, and a management team that are sort of incentivized to do the right thing for bondholders and creditors.
Thinking about inflation, and you touched briefly on the fact that the US maybe more rate cuts are priced in there. I suppose thinking back to most of this year, I've been thinking that inflation has been stickier in the UK and in the US, less so in Europe. So maybe the ECB is more predisposed to more rate cuts. This seems to be pivoting slightly due to maybe the challenge on the Fed's independence and maybe a push for lower rates. Where does that leave you in terms of opportunities in portfolios?
One of the things that we're noticing with the US in particular is that inflation expectations are actually not coming down.
No.
In fact, they're going the other way. So there's a bit of a dichotomy, if you like, between government bond yields coming down and inflation expectations going up. So that leaves me a little bit nervous. Ultimately, I think that there'll still be sort of volatility in US rates, and it should still be a sort of free market, if you like, or a transparent market ultimately. It also means that we have a bit more diversified duration exposure. So we have some US duration, but we also have some European and UK duration as well.
Tristan, growth, higher inflation, these tend to be quite good things for equity investing. But what are the pitfalls and how are you managing them?
I guess we try to build a portfolio that will work in any environment. No idea which way inflation will go. But certainly, I guess we had a dry run through 2022, 2021. And the sort of things that didn't work really were anything with low margins to start with, where if you have a long lead time to when your product gets sold, then you can't push the price as fast as your costs are going up. If you're in an industry where you have to hold lots of inventory, So you've got to buy that inventory before you can then sell it again. You've got to pay a higher price before you sell it. That's a cash squeeze. Similarly, if you have to buy lots of equipment and you sort of CapEx, if you're a CapEx intensive business, then all that equipment costs more today before you can finally produce a product that you're then going to sell it for at a higher price tomorrow. So all these sorts of things really sort of squeeze cash even more so than they already also squeeze the income statement, which is a key. Obviously, we're looking for the cash to pay the dividends, so that's the reason to really focus on it a lot.
So companies with pricing power are sort of a key to you?
Definitely. I think it's a broad term that often it can apply to lots of different things. You may have companies that you think have pricing power and exceptionally strong and can push price through eventually. But if you can't push it through very quickly, then that can actually lead to an impact, certainly on the share price, if not on the income statement. So yes, I think a general quality lens will help, both from the perspective of inflation and also with interest rates.
Absolutely, I see. Maybe a question I want to sort of open to all of you. What happens if we do see sharply lower US rates and potentially even another round of QE? What's the playbook, James? Maybe start with you.
That's a good one, because I think the sort of stereotypical playbook, if you like, would be sharply lower rates means the economy is going into a recession, which means that credit will perform poorly because companies will default more and have poor fundamentals. However, over the last sort of 10 years, what we've seen is actually the opposite, that when economies slow, you get these kind of financial repression antics and behavior, and you also get central banks kind of responding to low growth with financial repression behavior themselves as well, which ultimately crowds investors into yield and spread product. And so somewhat counterintuitively, the kind of highest yielding and therefore kind of riskiest parts of the credit market actually perform the best. Defaults remain low, spreads compress, and high yield does really well. It shouldn't happen like that, but again, because of kind of QE and the search for yield, that's ultimately how it's played out. So I would actually expect the same thing to happen again, at least as a base case, is that if we do go down a QE route again, credit product will actually perform pretty well.
Karen, does that sort of resonate with some of your experience?
Yeah, and I think the whole thing here links to why we're going to get the rate cuts. And if we get those sharp rate cuts because growth is in a bad place and we've got that recessionary outlook, then that is going to trigger a different reaction than if we get that the rate cuts because of political pressure, particularly if inflation's still high. So I worry a little about that outcome. That we have high inflation, growth sort of rumbling along okay, but we get the rate cuts anyway. And will that spice equity markets in a way that maybe isn't necessary at that point in time? So I suppose those are the things that make me concerned a little bit. And the inflation piece, that pass-through of inflation hasn't really hit the consumer fully yet. And when I talk to our analysts in the US about that impact, they're now pushing it back to Q4. So it's coming through a little, but companies aren't passing through tariffs in full whack yet. So, and they're also not seeing that huge margin pressure yet. So this story has got kicked down the road a little bit. But the US is a consumer-led economy, and the consumer hasn't quite felt that pain, but it's either going to be pain for the consumer or pain in margins somewhere down the line. So that feels like it's coming as well. There's a few things feeding in that give us cause for concern.
Yeah, so that's something we're definitely seeing in the equities as well. I've noticed that the tariffs, they've all been discussed and companies have started guiding for it, and they'll talk about it in company meetings with us and so on. But really, they don't know where exactly it's going to land and how this is all going to play out. So you can see now price is starting to come through in sentiment data. You can see it, higher prices in PMIs, for example. Companies say they're going to push price, but as you said, it doesn't show up yet in CPI and PPI.
And I suppose dividend stocks, something that you focus on, they can provide a bit of a cushion in some of these scenarios. So I'm interested, where have you been seeing value there this year, and where are you sort of looking? Where are you looking to next?
So I guess we don't look thematically or at sectors in particular. We look at whatever opportunities come up. And I think one thing we've seen in common across a lot of sectors actually is the impact of COVID, which even though it's 5 years ago, is still actually unwinding. So if you look at the luxury sector, for example, they obviously managed to push lots of price, had lots of demand in the aftermath of COVID. And now those huge margins are now coming back down to normal. And it's a call on whether the margins are actually going to stay at this baseline that was a long-term average or whether they fall through it. You have healthcare equipment companies and the industrial companies that supply them. They obviously, if you were in the COVID exposed bit of it, you had a huge surge in demand. These companies built loads of inventory, had great margins. All that is still unwinding several years later. And then on the other side, you've got things like aerospace, travel, airlines and so on, which effectively shut down. And now they still haven't, I mean, you can't shut a production facility and then expect to suddenly ramp up to 100% again straight away. So they're still getting back up to speed, still working through that backlog. I think generally, when we look at lots of companies at the moment, and it's common across lots of sectors, you often see that the last 5 years you've had a tailwind from price, effectively a tailwind from inflation of, and call it 5 or 10% a year to top line. And most consensus estimates, or people seem to think that can be continued. They extrapolate that into the future as in estimates. And then because it's in estimates, the multiples reflect that as well. And a lot of that is starting to unwind. And that's sort of where we're finding or trying to find opportunities.
Caroline, are you looking in similar areas from a multi-asset perspective, or have you got some other ideas? I'm particularly sort of thinking about European sectors here.
Yeah, I think we do look at sectors, and it's hard to get away from the fact that it's really been tech that's led the way for, well, quite a lot of quarters now. But certainly even in the last quarter, US tech and earnings growth has been so strong there. Financials has been a really interesting play. And I suppose that's the other sector that has at least had some earnings growth, both in the US, and we've seen some European financials performing quite well as well. So it's definitely areas that we've stayed allocated to, specifically financials and tech. Outside that, there hasn't been a lot of earnings growth. You'll see some stock specific earnings growth, but broadly at sector level, it's been really hard to find other sectors that have been driving earnings growth and the market forwards. So yeah, those are our two favourite picks, but there's some really interesting bargains to be had now, I think. Sectors that have derated, where there are opportunities to come.
Financials, Tristan, you also, that's also an area that you look at, isn't it?
It is. We've had a very long-standing overweight to financials, particularly in insurance. Although I wouldn't say that's not a macro-led decision. I think these companies, particularly the insurers that we own, are not macro-sensitive. So obviously within the insurance bucket, you've got life and non-life. We very much focus on the non-life side, and their earnings, if you think about the car insurers, for example, they're dependent on whether people crash or not, which is not economically sensitive. Similarly, for a reinsurer, they're dependent on which way the weather blows, whether there's been hurricanes or earthquakes and so on. So again, not economically sensitive. So we find those particularly appealing.
Any of these ideas feed into anything you're looking at, James?
They do, actually. So it's interesting that there is quite a lot of overlap between Fidelity's equity income likes, if you like, and credit income likes as well. So in a similar way to how we're both effectively sort of underweight the US, we are both effectively overweight financials and insurance as sectors. In sort of bond world, financials obviously have sort of different layers of the capital structure. So you can have senior debt, which is very safe but also quite expensive, but you can take a bit more risk through subordinated layers of the capital structure as well. And so we like those subordinated bonds in both financials and insurance.
Right. Well, I think it is probably about time to start drawing things to a close. And Caroline, coming back to the question that we began with, which is, given where markets currently find themselves, how can you build a bit more resilience into portfolios? What have been your key takeaways from today?
Well, I think I'm lucky because I'm multi-asset, so I can take the best of both worlds here, and also from other worlds too. So aside from the alternatives revenue streams that we can get in our portfolios, I think my takeaway is that there are some good opportunities in equity income, but also that the breadth of opportunities on the fixed income side gives us room to think about different ways of getting exposure. So I'm quite excited about some of the positions that we can put into the portfolios to give us that resilience. It could be a very interesting final quarter of the year.
Let's hope. Right, well, before I let you all go, we're going to play hotcakes and hot potatoes. What are you buying like a hot cake and what are you dropping like a hot potato? Let's start with you, Tristan.
So I would say no idea what happens in the next 6 months, but over a longer time frame, I would say hot potatoes. Things I'd be nervous of would be all these perceived winners from AI, ones that are particularly highly rated. And then on the other side, on hot cakes, things I would be interested in are things that are actually AI winners but have been underappreciated. So from the picks and the shovels, further down the value chain.
Excellent. All right. And James, hot cakes and hot potatoes.
So on hot potatoes, somewhat similar, I would say, sort of structurally challenged credits, whether they be in sort of AI disrupted or disruptable industries, maybe in clean energy, which is being challenged on a number of fronts at the moment. Maybe where there's some redundancy of efficiency or operations and so on. And it feels like the kind of market environment which is generally quite robust but very unforgiving of structurally challenged business models. So that's definitely a hot potato. And then hot cake, I'll be a little bit contrarian here and say sterling credit. So credit denominated in British pounds. So as you'll probably know, gilts are under a lot of pressure at the moment. Lots of concerns about budgets, about fiscal discipline, about the Labour government and so on and so forth. However, sterling credit is actually, in pretty good shape. And yet it prices off the gilt curve. So therefore yields are very high. Potential returns are pretty strong. And so that's an area of the market we're focusing on.
Okay. Caroline, how about you?
Yes, my hot potato, I was going straight for UK gilts. The conversation is now going to make me go upstairs and look at UK credit, which is exciting. But on the UK gilt side, we've been trimming positions already. Sticky inflation, rate cuts may not be as easy, but the political and fiscal uncertainty is a worry coming into the budget. So that's my hot potato. On the hot cake side, we've been holding the hot cake of gold for quite some time now. I'm going to carry on holding that hot cake. The other things that, for the resilience perspective, value, leaning into dividends and leaning into min-vol. It's a lot of hot cakes.
No, very good. Lots of ideas there. And lovely to hear that you're actually being productive here from a portfolio construction perspective as well. Great. Well, thank you very much, everyone. That really is all we have time for. Thank you to Caroline Shaw for helping me work through our guests' arguments today, and to our guests for providing the ideas, portfolio managers James Durance and Tristan Purcell, and also to credit analyst Odman El Iraqi. And thank you for listening. You can find out more on the topics we've discussed today on your local Fidelity website or at fidelityinternational.com. If you've enjoyed today's episode, please share and subscribe. The producers today were Holly Eastman and Patrick Graham, with production support from Connor Bailey and Alex Wilcox. For now, from all of us at Fidelity, goodbye.